Welcome, viewers. Today we are back with our new presentation that is about active income, passive income, and portfolio income. So here today we are at CST time 12 p.m. and we are in Central Time Zone. Uh, Today we are going to focus on different different income type of income, and the reason of covering this topic is we have heard so many queries and so many questions about passive income. Everybody knows mainly about the active income because it's W2 and those kind of income, but when it comes to the passive income, mainly it's a rental income, and people have questions about how they can offset their losses with the active income. And today, we will focus on that. Also, you may have a question about your portfolio income. So, we will cover all that. Please, please welcome my friend and my counterpart, Abhay Jain, who is a CPA, and he will explain you how this active income, passive income will work and help you, and what are the tax consideration for them. Hi, Abhay. Welcome to the show.
Good afternoon, everyone. Welcome to today's session. Today, yes, we are talking about active income, passive income, and portfolio income. There are different types of income, but these three are the most common types of income. So I'll start with active income. Active income is also called earned income. Basically, that is the income which you earn working for yourself or working for someone else. Like W2 income, if you have own business, like small business, self-employment income, or if you have a partnership or S corp, you get a K1 forms. So all and you are actively involved in day-to-day operations. So that's called your active income. Yes, there are few notable benefits and drawbacks with active income. So I'll start with advantages. Advantages: earned income act as a traditional source of living, which requires material participation. Also, active income gives us regular stable income every by we get payroll paychecks every week, bi-weekly, every month. Also, you can control, you have a direct control on your active income. Like if you want to earn more income, you can increase your productivity and career advancement. Yeah, yes, there are limitations with the active income also. So for most important is time constraints. Yes, it since you are actively involved, you have spending your one third of daytime period with earning this income. So yes, there is a you cannot earn more beyond certain point of beyond certain point. Also, this active income also depends on economic crisis. Like a few years ago, because of COVID-19, many people lost their jobs and many businesses were shut down. So economic because of economic crisis also, this active income depends, and that's a limitation. And with active income, about from tax point of view, active income taxpayers, they generally pay higher taxes as compared to passive income taxpayers, because active income involves self-employment taxes, or this is called payroll taxes, like social security and Medicare taxes. Okay, now I'll talk about passive income. Passive income, it's a very interesting topic. It's income earned with little or less ongoing efforts. That's called passive income. Yes, it is possible to make money without actively involved for it. The most common example with passive income is rental income. We can get monthly rental income without actively involved for it. If And we can also write off expenses as well, like property tax, interest, HOA, which helps in reducing taxable income, and we will get we end up paying less taxes. And with passive income, as I mentioned, there is no social security taxes involved. So that is the number one advantage. Also, time freedom, like it allows flexibility to pursue your other interest. Also, you can increase your wealth and income from different sources, because you can spend more time in different source of income. uh, Advantages are that's what the advantages, and limitations with the uh, passive income is basically required. So the major is higher investment. We also talked about in our uh, last insights about real estate and active income. So and also real estate income, also it all there is a market risk involved, because fluctuations in real estate can also impact your steady income. Thank you. And now Abhishek will give you more insights about portfolio income.
Thank you, Abhay. Thank you for detailed explanation on active and passive income. Now, there is one more category of income, which is, as per IRS perspective, that is portfolio income. Now, what is portfolio income? Most of you may know about the portfolio, like investing in the stock market and generating income from the investment. That exactly it is. That is what exactly it is. Um, Portfolio income, when you generate income from the investment in financial assets such as stock market or bonds or mutual funds or EFTs. This are portfolio income. This mainly includes your income from dividends or or interest or maybe a capital gain. So this are a portfolio income. Now there are some pros and cons for that. Yes, of course. There are some pros. So let's talk about pros first. Biggest biggest plus that I would see here is a growth potential. We all love it because portfolio income offers capital appreciation and growth as investment that investment in your asset increases in value over, and it will increase over a period of time. So that is a big plus here. You can also earn handsome dividend. You can earn income on your investment, and that will also add to your investment the investment basis, investment money. Another is a liquidity. Liquidity is also a very good aspect of this, because investment in financial market that provide you very good liquidity. You can enter in the market, you can sell it, you can buy it, or or you can do multiple things. You can go in the market and take a loan on it. So there are so many things that you can do. You can access your cash whenever it is needed. One more thing, let's talk about diversification. Diversification is also a very good feature here. Portfolio income allows you to diversify across asset classes, sector, region, wherever you want to invest. Let me give you an example. Like you may want to invest in Asian market. You may want to invest in certain sectors like IT or healthcare. You can do all this with your portfolio, so that is very good. And one another thing that this strategy can reduce overall investment risk, because now you are dividing your risk between so many markets. Another is let's talk about cons now, because we have a limited time, so we can talk about cons also. We don't want to miss it. So one important thing about cons that we have to keep in mind is market volatility. Market volatility is sometimes due to some economic conditions, geopolitical events, um, of course sometimes investor sentiment. So many things are responsible for market fluctuations, and that can impact your income. And because of this, there is a risk of loss. So investment, of course, any investment carry inherent loss. That is inherent risk. It is always there. But capital loss may occur due to this asset value, declines. Uh, Here we also want to focus one thing on complexity. Sometimes it is complex when we talk about diversification, because managing diversification in your portfolio is not as easy. It needs some knowledge and risk management, and there are so many other things that you have to take care of. You have to study that. So either you have to gain that knowledge or you have to take advice from the experts. So each investor may face some challenges, but otherwise this can be you can overcome with someone's advice, of course. Now there are a big there are a big area of tax consideration here. There is a big tax consideration that we have to keep in mind, and I'm sure that you will like it. Capital gains and dividends are the two source of income from portfolio income. Now, when we talk about long-term capital gain and qualified dividend, particularly, these two are taxed at preferential rates, and these rates are between 0 to 20%. Now, this is a very good for people who are in a higher tax bracket, who pay taxes at the rate of 30-35%. So they should definitely take advantage of this. Another is a short-term capital gain. Now, short-term capital gain are generated when asset you hold for a year or less than 1 year. Uh, they are taxed at ordinary income rate. So people who have an ordinary income rate like about 15%, and they can take advantage of this. So this is also good for different people, different class of people. So you always have to keep in mind that who you are, what are your objectives, and what do you want to do. Your loss appetite also. Uh, One big thing that before we close I would like to focus on, that is tax advantage accounts, how you can maximize your tax benefits. That is the area that I would love to talk about. What are tax advantage account? Uh, IRA and 401k plans that offer tax deferred or tax free growth. Now we have talked in detail in our last video about it, so I would really encourage you to go back and uh, and watch that video. But here that I would like you to focus on that uh, if you have a 401k account, or if you have a IRA account, then depending on your contribution and account type, you can save a lot of taxes here. So in summary, understanding the difference between active, passive, and portfolio income is very crucial for effective tax planning. Combining multiple stream in income can enhance your financial stability, and not just financial stability, it can reduce your capital risk. So remember to tax maximum benefit of available deductions, credit, and tax advantages account to minimum your tax liability. Uh, Thank you for joining us. We may have few questions today, so this will be, we will take few more questions. But before that, I think Anil will give some more idea about all this income and how it can help you guys.
Sure. Thank you. Thank you very much, Abhishek and Abhay. It was a great presentation. And just to summarizing whatever all two of our team members shared here, in simple summary, we have three types of incomes: active, passive, and portfolio. So they are like brothers, and so sometimes those losses from any of these segments cannot be adjusted with the other segment. In simple summary, any losses from the real estate properties, like through real estate income, those are called passive losses. Those passive losses cannot be adjusted with active income, which is your business income, which may be a K1 from an operating business. Same with capital gains or capital losses. if you incurred any capital losses from the sale of your stock or a real estate property, these losses cannot be adjusted with an other brothers category, which is an active income or passive income. So in simple terms, there are three categories of incomes. A lot of people get confused here. So in one losses cannot be adjusted with other incomes. This is a very important one which everyone should know. And it's all about diversification of your investments. It can be real estate properties or it can be the stock market. And it's an act, and you do also have an operating income, which is your business income or K1, K1 from operating income, operating business, or from your W2. That's all for us, and I hope this helps you to get a clarification on what are the differences between these types of incomes. And if you are watching this recording later, please feel free to go back to the feel free to post your questions in the comments box, or if you're watching live, feel free to post your questions in the comment box. We will try to answer the on any questions from the comment box right now. Thank you very much. Abhishek, can you see the questions? There is
No,
a
I
question
don't
from
see
Kumari.
any.
Yep, I can see the questions, and I posted it on the live now.
Okay.
So I'm just
Yes, I would
everyone
like
can
to
see these
answer.
questions
I would
now.
like to answer yes. Yes, if you
Please.
bought an office, if you are operating your LLC as a S corp and you bought office space, yes, you can claim all these deductions, insurance, property tax, and also you will qualify for depreciation deduction also. If you are the owner of, but if you are renting it, then you can claim rent expense. But if you are the owner, yes, you are allowed to take depreciation, insurance, property tax, all these expenses, even HOA if there that area involves where you need to pay HOA. Yes, you are allowed to take those deductions in your S corporations, and that will be considered as active income, net active income. That will reduce basically your taxable income, and you are allowed to write off all these expenses.
Yeah. I will just add on. Thank you very much, Abhay. Kumari, it is a very good question. Yes, under the same LLC, if you are buying a property and you are also having an operating business, but the property has to be used for the own usage purpose. Like example, I am running a business AZ Fintax. If I am having this office in my own office, then yes, the own office is becomes a passive. It won't be any more passive income or passive losses. It is an active income or active losses from that property. So I can claim all property related expenses and depreciation. And if I get any losses from the usage of the property or because of the depreciation, those losses will be adjusted with an active income. But the point here is, if you are using the property building for your own usage, then it is considered as an active, not a passive. So this is an exceptional, but your question is very good. So, and in
Right.
general, if you are having any investment property, we recommend you to hold that property under LLC, which is a passive income or passive losses. S corporation is only for the operating business. Maybe like example, in my example, AZ Fintax, it's an operating business. This is under S corporation. But if I'm buying any properties outside for my investments purpose, I will have it under a separate LLC so that I don't combine these two. But the exception is if I'm buying the office for my own usage, for own AZ Fintax operations, then it is okay to buy the property under my S corporation. But there are some risks also there. You need to consider the liability risk when you are buying the property under same operating business LLC name. So yeah, thank you. Is it
Right.
bad? Is it a bad idea to register real estate under S corporation? Answer is yes, Kumari. Unless you are having an operating, you are using it for the own purpose. In general, yes, we don't recommend to buy real estate passive investments under an S corporation. S corporation is only for the operating business. And you do also have one more question. Can we do same thing for the partnership too? Answer is yes, Kumari. Yes, we can do the same. Yep.
Thank you, Anil. Thank you. I will
Yes,
add one more thing here that
please.
this recording of this live stream will be available on YouTube, Facebook, LinkedIn, and Instagram. So feel free if you want to watch it again or refer to your friends, and they can go and watch it too.
Yeah. Thank you. And thank you very much. Thanks everyone for joining this session. And let's meet you again next Thursday at sharp 12 p.m. CST with some new topic.